House Speaker Nancy Pelosi has paved the way for the real work to begin on the large $3.5 trillion infrastructure package. It's going to go through the filibuster-proof reconciliation process, and the intent is also to take the bipartisan infrastructure package to a vote by the end of September. We continue to take the under on the ultimate size of the reconciliation deal, and this leaves investors wondering where the next catalyst for growth will come from. Our answer? Inventories. What might this look like? Let's break it down. So to set the stage, the well-documented supply chain issues that are plaguing many industries have left their mark on store shelves, which are relatively bare. Companies struggle to source key inputs, and this has been a drag on growth. We saw that very clearly in the second quarter GDP print that came in disappointing, largely for this reason. Lack of supply was also curtailing demand. The most recent report from the Census Bureau on monthly inventory to sales, that's effectively a measure of how many months of inventory companies are holding, reflects this challenge as well. At a decade-low level of 1.26 months, it's clear that companies are operating a bit too lean, and once the supply chain challenges abate, we anticipate a healthy restocking. And these bare shelves are going to be restocked and then some. The restocking may actually bring inventory levels to above historical average as companies trade a just-in-time inventory management philosophy for a just-in-case, building in more resilience to their supplies. This has been one of the key lessons learned during the pandemic. For investors, it means that the baton pass from fiscal and monetary policy to the private sector will enable the economic recovery to continue into 2022. The risk case, of course, is that the baton pass is incomplete, creating a large fiscal headwind relative to this year. For us, the base case is that demand remains robust enough at the consumer level to support this inventory rebuild.